It's true. The Australian property boom is over. But what does that mean for you as a property investor? Is now the time to sit back and wait? Or should you be looking to go through the data and find opportunities that perhaps others are unable to find? Well, that's exactly what I'm going to cover in this episode. Hi, it's Nero here from Investment Rise, and today I want to go through some hardcore data, some hardcore facts about what's going on around the country, and then share with you where I think some of the best areas are for you to invest in right now. Now again, none of this is advice. I don't know your personal situation at all, but this is just based on my now 20 years of property investing experience. I have invested successfully and made money by finding areas with good capital growth potential, even during periods of time when interest rates were rising. Okay, but before I share exactly where I think you should be looking to invest and what areas to avoid, let's start by looking at a general market update. So here we have the CoreLogic RP Data Daily Home Value Index, the monthly indices. And again, we're going to be focusing on houses. If you've been following my work for any length of time, you know that I focus almost exclusively on houses because I think we know by now that it's, generally speaking, capital growth has been far better in the house market than the apartment market. Okay, so focusing on houses here, Sydney had a price drop of 1.8%, which is the largest price drop it's had for quite some time. I'm not talking just in 2022, I'm talking it's going back now to sort of when we had the last downturn, which is between 2017 to 2019. So we're talking a pretty significant downturn on a median level, okay, median price point level. Melbourne had a price drop of 1.3%. Brisbane, for the first time, did not have a positive capital growth. It recorded essentially zero growth for the month. Adelaide still showing strong signs of growth at 1.3%. Perth, 0.4%. Okay, so if you look at that, it certainly seems that the market is nowhere near as strong as it used to be. We know that, and maybe you might be thinking, oh, okay, well now is the time not to invest. But what you can see here is that this data is all based on capital cities, because why? Because I guess that's where all the attention goes to, right? That's where most Australians live. Most Australians do live in capital cities even today, despite the fact that so many people are moving out of the capital cities. You'll still find that the majority of Australians on a nationwide basis do live in capital cities. One of the exceptions being Queensland, where now 60% of Queenslanders live outside of Brisbane. So they live in regional areas rather than Brisbane itself, okay? But generally speaking, the majority of Australians around Australia live in capital cities, and that's why the media focuses very heavily on that, and that's why a lot of these general data metrics also focus on capital cities, okay? But if we just drill down into the capital cities, like let's take Sydney, for example. As you saw, it had a price drop of 1.8%, but that's median. Some suburbs, though, are bucking that trend, and they're doing quite well. But others are doing quite badly. And I want to focus on what some of the worst performing areas in Sydney are right now, and the ones that are at the biggest risk of prices dropping the most. So here's a recent article which says 1 in 4 home borrowers across large parts of Sydney's west and southwest were already paying more than 30% of household income to service their mortgage before this year's interest rate rises. These housing stress hotspots will soon come under added financial pressure, with the Reserve Bank expected to hike interest rates by 0.5 of a percentage point on Tuesday, taking the benchmark cash rate to a 3-year high of 1.3%. The 2021 census conducted last August and released last week revealed 7 Sydney local government areas disproportionately exposed to higher borrowing costs. Burwood, where 25.9% or over a quarter of home borrowers were already paying over 30% of household income on mortgage repayments. Canary Bankstown, 25.6%. Fairfield, 25.4%. Cumberland, 24.7%. Parramatta, 24.3%. And Georges River, 23.9%. The census also identified suburban pockets with an especially high share of pressured borrowers. In South Campsie, 4 in 10 home borrowers, or 38.8%, were paying over 30% of household income on mortgage repayments. In many other suburbs across Sydney's west and southwest, the proportion was around 1/3, including Hurstville Central at 32.6%, Guildford South Granville 32.9%, and Minto St Andrews at 32.3%. So what does that tell you? Well, it tells you that based on the data, it's actually the more affordable areas in Sydney. And when I say that, I'm talking about relative to the median price point, okay? So I guess the lower price suburbs in Sydney are, strangely enough, they're the ones that are currently under the biggest stress from a mortgage perspective. They're under the highest mortgage stress, okay? So as an investor then, if your budget was, say, under the median price point of Sydney, so if you had a budget of, say, under $1.6 million, would you be targeting these more affordable suburbs because they fit your budget? I'd have to say absolutely not, right? Because these are the suburbs that are at the biggest risk of having higher than average price falls, okay? On the flip side, some of the more expensive suburbs like Wahroonga, for example, on the north shore of Sydney, it's actually holding its value and even increasing slightly, okay? So even though you're looking at these median price point data, they are just a great starting point, because remember, when you invest, you don't invest in an entire city, you invest in an individual suburb, and then within that suburb, you don't just invest anywhere, you invest in particular sections in a particular street of that suburb. And so you really need to get granular when you're looking to do your research, okay? And the fact is that in Sydney, not all areas are being affected equally. In Brisbane, not all areas are being affected equally. I mean, like you saw, for example, the median house price growth was 0%. But that's because some of the more expensive areas in Brisbane, they're the ones slowing down the most, but sort of the more affordable and median price suburbs in Brisbane, well, they're the ones still rocketing along. It's actually almost a reverse situation in Brisbane compared to Sydney. And so you really need to understand what's going on, because it's too easy when you're seeing all this noise in the media about property prices falling and etc. And there's almost a new headline every day if you look for it. It's too easy to go, there's just so much bad news, I'm going to sit out, okay? But what I can tell you is the most sophisticated investors, the most experienced investors, they're the ones who are entering the market right now and snapping up opportunities, all right? Many of our clients are returning now to buy their second and third investment properties because they understand that there are some great opportunities out there, either to find markets with great long-term growth potential where they can get a discount right now, or they know that there are markets out there that are bucking this trend and that are still growing significantly and can still give them some good short-term capital growth as well as long-term capital growth, okay? And part of this is because we look at the country as a whole. So yes, I've shared with you data about the capital cities, but now let's have a look more in depth at what the country is doing, especially looking at capital cities versus regional areas. So here we have some CoreLogic data showing dwelling values for the last 3 months. And these 3 months are to the end of May, but I still think it paints an interesting picture, because what you can see is that Australia as a whole for the 3 months to May increased by 1.1%. So the median dwelling price, so this does include houses and units, yes, but it does show you that the median dwelling price across Australia rose by 1.1%. But if you look at just the regional areas and combine them, they grew by 3.6% versus our capitals, which only grew at 0.4%. Okay, so you can see that the regionals have outperformed the capital cities, and I think that's going to be a trend that's going to continue. Now, that does not mean that you can just go and buy in any regional area. There are a number of factors you want to look at. However, if we look at now the rolling quarterly change in dwelling values, what you can see here is that this dark line is the combined capitals, and then the light purple is essentially the rest of the state. So we're talking now the regional areas. And what you can see here is volatility. So you can see that the capital cities have higher highs than the regionals, but the capital cities have lower lows than the regionals as well. Okay, so here we go again, higher highs back in, 2016, 2017, but then much lower lows when we had the downturn, okay, especially in Sydney and Melbourne markets. You can see consistently, and this is becoming a trend that's even more prevalent, is that yes, capital growth can be higher in capital cities, especially when everything is going well and there's a huge housing boom. But on the flip side, it's the capital cities, especially driven by Sydney and Melbourne, that can fall the most. Okay, so regional areas tend to hold their values and are much less volatile and lower risk in many ways. Okay, now let me pause here for a moment, because if you think regional areas, maybe you've been taught, and I did some research earlier on this year when I read a number of books by different authors, and almost all of them talked about the prevailing wisdom of investing in blue chip areas. Okay, I think there was one author who differed. She said that you should invest in an area that's about to become a blue chip area. Okay, but they were all talking about this concept of blue chip. Okay, and so therefore many people have been taught that, oh, you invest in capital cities for capital growth, but you look at regional areas just for cash flow. That's all you worry about. You look for the positive cash flow, okay? But the data shows that's not the case, okay? Now, of course, if you get this wrong, if you go, for example, look in a regional area that might be dependent only on one industry, for example, say many areas associated with mining that really, suffered badly, okay? Yeah, you're going to have massive volatility. You're taking a massive risk. But if you can find regional markets that have good access to employment, where there is lots of jobs, lots of different industries supporting the area, you're not going to have that same level of volatility. Okay, and right now I'm seeing many regional markets outperform the capital cities, and a trend that I think is going to continue for quite some time yet. And this isn't new. Okay, back in 2002 when I first started investing, many people don't realize that I started investing in regional areas. Why? Number one, affordability. Okay, I couldn't afford many of the capital cities. Number two, I wanted the stronger rental returns, the stronger cash flow, and I wanted ultimately positive cash flow, and I knew that regional areas had a better chance of giving that. Plus, I wanted the lower risk. And having been brought up in regional Australia, I did all my high school in a regional area, I didn't have, I guess, the misconceptions that many, I guess, city people have about the regional areas, thinking, oh, they're just a small town or whatever. I understood that many of the regional areas around Australia have very strong economies, okay? And so that's why I was able to target regional areas, and that's where I actually started my investing before then moving to capital cities, okay? And one of the reasons why I think regional areas are going to do so well right now is because of the really tight supply. Let's take regional New South Wales, for example, okay? So here's an article that talks about how city dwellers escaping to the regions are putting pressure on a severe rental shortage with a vacancy rate below 1% and double-digit rent rises across most of the state, all right? Now, this isn't just regional New South Wales. You're seeing the same thing in regional South Australia, regional Queensland. I know some of my properties in regional areas have already seen rents rise quite significantly, offsetting the interest rate rises that we've had, and I know we're going to see a few more. Okay, so as an investor, if you're someone's trying to lower risk, if you're risk averse, if you want to look at a more affordable price point, then I really think you want to turn your attention to either the regional areas or the smaller capital cities like your Adelaide, your Perth, your Brisbane, for example. Okay, these are the markets that I think are going to far outperform Sydney and Melbourne and Canberra. Okay, I think you're going to do much better there than just waiting out the market and keeping the money in cash. I mean, with inflation being so high, money in the bank, it really isn't going to do anything. Okay, so as an investor, it's a time to be judicious. Do your research, make sure you're doing the right due diligence, and I really think getting the right expert help is going to help you, because there are opportunities, and there is no doubt in my mind that in 12 months' time you are going to hear about people who invested by being borderless, by not restricting themselves to just looking at their local markets and the suburbs around where they live. They started looking outside of where they live, outside of their local state, and they found opportunities for great capital growth where the rents are virtually covering the mortgage, if not even giving them positive cash flow. And you have an opportunity to really be part of that trend. Yes, it might seem a little scary buying property in an area that you don't know, buying property that you can't see, buying property that you can't drive past on your way to work if you still go to work, okay? But the fact is that when you're buying an investment property, this should be a numbers game. It should be based on data, it should be based on your risk profile, and if you have the right team around you, Okay, whether it's a buyer's agent like ourselves, okay, or whoever you feel is right for you. You have the right rental manager who's going to look after your property and be your eyes and ears on the ground. We're not talking about just some junior here, but someone who's experienced, who understand what interstate investors are looking for and what extra care they need. If you have the right people on your team, now is a time for you to get some great opportunities. But if you're the do-it-yourself investor, the risks may be too high. So it's really a case of, are you willing to get expert help, get the right team around you? Then I think there are some great opportunities and you can really cut through the noise. But otherwise, you are going to be someone who's going to be left confused and wondering what's the right thing to do. And then when you read about people's success stories in 6 months, 12 months, it could easily lead to a lot of regret because you have that same opportunity right now. All right, so I really hope this is sort of helping you, showing you what's going on in the market. Yes, you need to be judicious. Yes, there are some markets you need to stay away from, but that doesn't mean that the entire country isn't doing well. That doesn't mean that there aren't opportunities. It's just about finding them and cutting through the noise. Hi, it's Nero here again, and thanks so much for watching. If you like what you saw and you're looking for a proven recipe, a blueprint on how to build a property portfolio that gives you passive income, then click the link below this video and get a copy of my book, Wake Up Wealthier, How to Build a Property Portfolio that pays you an income each and every month. Okay, when you click the link and you download your book, you can get both the digital version and the audio version in case you don't like reading. All right, so I used to sell this book for $49, but right now I'm making it totally free. Why? Because I want more people to get this information, and I know that a segment of you will then like what you see in the book and choose to reach out to find out more about our services. But even if you don't, if you're serious about building a property portfolio that pays your passive income, then you really want to get my book, Wake Up Wealthier. It contains the secrets that I have fine-tuned over the last 19 years. It's totally free for a limited time. Click the link below.